Hello, Mavericks. It's nice to see you here, and I cannot believe that it is August already, and I can't believe that summer is two-thirds over. And for those of you that have kids in school, your summer is basically over. I'm sorry to say that. Now, my kids are all grown and out of the house, and so I actually get an extra like 3 or 4 weeks of summer. But sorry, Darren, your summer is almost over. When does your boy start?
Oh, I think 15th or 16th of this month. It's gone quick. It has really gone quick.
Yeah, it has. Sure has. All right, so let's get into it. Market had a big move last week. We saw a lot of bullishness, and it was really due to the FOMC meeting. So we were down 1.5% the first 2 days, and then we rocketed it up. We had a huge run those last 3 days, and it really all came from the FOMC meeting on Wednesday. Now, what happened is they came out and they raised interest rates by 0.75% as expected. And the market didn't do anything for a while. It actually went down a little bit, went up, and it just didn't do anything for a while. Then in the press conference, the question came up, and Chairman Powell basically said that as the data softens, they're going to soften their policy towards more rate hikes. So basically, they're saying they're really thinking or looking at slowing down the pace of rate hikes, and the market really liked to hear that. And so the markets just took off. We also had big tech earnings this week. We had earnings from Amazon. The numbers from Amazon weren't good. Guess what? The market didn't care. They bid it up about 12%. The numbers came out for Google. The numbers were okay. The market took them up 4%. Numbers for Microsoft came out. Not all that great. They took Microsoft up. So it was one of these things, whenever you see bad news get bought, it's really a sign that you're closer to the bottom than the top. Now, look, I'm not calling the bottom in any way, shape, or form, but what I'm saying is when bad news no longer moves the market lower, it's probably reached a bottom. So the markets are acting like that. We're going to look at the charts, and the charts have completely turned around here. So let's take a look and see what happened on the economic reports this week. On Tuesday, we got a manufacturing index number that was a 0. Now, a lot of people say that's a bad number. Well, last time it was negative 13, so an improvement there. We got 2 consumer confidence numbers this week. Both of them were a little bit worse than expected. Durable goods orders, a sizable jump, 1.9%. And the biggest one was the GDP report on Thursday. Now, it was a negative 0.9%. This is the second consecutive quarter with negative growth. Now, I've seen a bunch of people arguing online. I've even had a couple of emails sent to me. The technical definition of a recession is when the NBER, the National Bureau of Economic Research, when they say we're in a recession, that's what goes into the record books. Now, here's the problem, is that they look at a lot of things other than just negative GDP growth. And by the time they look at all these things and they finally say that, yes, it is a recession, we're likely out of the recession already. So a lot of people just use 2 consecutive quarters. Look, I don't care. I don't care if we're in a recession or not. The market has tumbled 25% this year because of the market action or the economic action. Whether it's a recession or not doesn't really matter. And frankly, the market says that maybe better times are ahead. What do you think, Darren?
I think a lot of fund managers, I think a lot of portfolio managers made 2 very large bets that you spoke on there. And when Powell says that as the data merits it, they're going to soften their policy. Take a look at the opposite of that. What if the data gets worse and the Fed has to keep the pace of the funds rates of the rate raises as it is, or possibly go on there? I don't think that is being taken into account, and that's just the way things are going. The other thing you mentioned is that earnings were a mixed bag, but we were still putting them up there. I mean, that's another large assumption that people are going on. They think that this is the worst right now. They think this is.
And I think regardless, we're looking at volatility going ahead. The market hates uncertainty. Right now, there's so much uncertainty out there about everything. And, if you remember, Darren, back when we bottomed out in June, I know you and I both said that we're probably not going to make another low until after Labor Day. Now, look, I didn't think we were going to get up as high as we were. And speaking of that, let's take a look at the market charts. I didn't think we were going to get up above 4,000 on the S&P, and we sure have. This week, Dow up 3%, S&P up 4%, NASDAQ, Russell, everything up around 3 to 4%, oil and gold. So just a nice solid week where people bought everything. And if we take a look at these charts, you can see that we are now substantially above the 50-period moving average. 3 days ago, we were at it. And we always have this as the line in the sand, like if you're above that 50-day moving average, then that's a sign that the market is more bullish than bearish. Things have drastically changed over the last 3 days, and the most intelligent bear cannot be bearish anymore. Now, look, you can make up reasons to be bearish, but on a technical basis, there is no more reason to be bearish on a technical basis. You don't have to be a raging bull. You don't even have to be bullish. But what you can't be is bearish. You cannot at this point. Now, look, if we turn down and we fall and we go back below those moving averages, okay, then you can get bearish again. But until that happens, you have to be sideways to bullish. You just have to be. Now, if you take a look at where we are right here, right now, there's a huge band of resistance on this SPY right between 410 and about 417. This is going to be a lot of overhead resistance to get up to. We spent a lot of energy last week, and I think we're going to be up against this level. So I don't think we're going to see any sort of breakouts next week. I think we're likely to get just some pausing and basing around these levels. Now that's the S&P. If we go over here to the Qs already kind of moved through that resistance that was set there back in the 1st of June. We are coming up to this other resistance here at 320 that we set back in February and March. So I think it's going to move up into these levels and also take a pause at that point. Now look, the market doesn't have to do anything that I think it's going to do. But I think that at this point, this run that we've had is near the end. I think there needs to be a pullback or a base before you can really take a lot of new bullish positions. Where this market goes, and again, this is always the difficult point in these turns where the bad news is still bad and the economy is still having all these issues. But the stock market tries to look through that to the future. And the market decided this week, maybe it's not as bad as we thought. So Darren and I were talking a little bit earlier. I didn't think we were going to come this far this fast. I've had to definitely change my outlook of what I thought the market was going to do. I thought we were in for a sideways summer. I thought we were going to go sideways all summer. And now I've got to say, hey, this is like a +1, +2 market. And I need to get a little bit more bullish. The volatility index says, yes, it should be a good sustained move. We've got really lower lows here. We're coming down into the lower 20s, which is the average range of the VIX. So volatility is coming out of the market. People are feeling better. Look, I don't think there's a ton of oomph, if that's a word, behind this move, but you cannot be bearish at this point. Any comments on that, Darren?
No, I mean, you and I have both been bearish. I think I've been more bearish than you, but you're absolutely right. I mean, this is why we preach: trade the market in front of you, not the one that you want it to be, not the one that you think it's going to be. And it's very refreshing to be able to do that when you can just take a look at the market and say, I really think that we've got some headwinds coming up in the economy. Personally, I think that we're going to go lower, but then to be able to take a step back and say, that's not what the data is telling me. Regardless of what my opinion is, I've got to take a look at the data. And you're right, that 50-period moving average, that is the line in the sand between bullish and bearish. We are firmly above that. You see the volatility, you're right, absolutely coming out of the markets. So we've got to be bullish. Now, I can have my personal opinion that the markets are setting everyone up to take a serious loss. That's my personal opinion. If I'm going to put money behind it, I've got to be looking at the technicals, and the technicals are telling me it's time to get more bullish.
And Darren, that right there, whenever I talk to our aspiring traders coming into the firm, that right there is everything. Once you can get to that point where you no longer trade your opinion, then you are a professional trader. And I know it took me years until I could trade opposite of my opinion. Like right now, I'm with you, Darren. I think the market should be way more bearish than it is right now. But guess what? I'm net bullish. I have to be. So that is where we want all of our traders to get to where we all have these opinions. And look, and our opinions are all formed by stuff like our upbringing, our personality, our political affiliations. All these things come into your opinions. And that's not what the market's doing. Just look at the chart and make your decisions off the chart. So let's focus on next week. So the markets are looking more bullish. We are up at overhead resistance. So I think we aren't going to go all that much higher next week, but you have to look at this market and say it's more bullish and bearish. We are in the last week of earnings, major earnings season, and this week is mostly commodity companies. So let's take a look at the calendar this week. This week, it's really all about Monday and Friday. Monday, the ISM number comes out. This one isn't all that important, so I don't think there's going to be that big of a move off it. But if you take a look at Friday, Friday is going to be the one. We do have payrolls report. And all of a sudden, now, if we see weakness, don't be surprised at all. If this number comes out weak, the market is likely going to cheer it. So let's say this number, the expectations are for 250,000. Let's say it comes out at 170,000 jobs created. I think the market goes up on that number. I think the market goes up because it says, oh, the Fed is going to start pulling back. If this number comes out hot, it comes out at 300, 400K, I actually think the market goes down. I know that's very counterintuitive. That's usually not what happens. But where we are right now, I think if this number comes out hot, I think people are like, oh crap, the Fed is going to stay aggressive. And we made a bet that they weren't. So let's retract that bet. What do you think about a hot employment number this Friday, Darren? What do you think happens?
You've got an interesting thesis there, and I could definitely see that. If it comes in hot, now I think what you're going to have to do, we're going to have to take a look at the manufacturing and services PMIs, and then also take a look at the employment report, and that's where we're going to see, are we still in stagflation, or are we picking up, or is it getting worse? I think you've got to contrast all three of those things together before you can get a picture on what's going on.
All right. So again, I was at a +1 last week, and we got to move this up to a +2. Look, I know that you may not feel like being bullish. I know you may not feel like the country's going in the right direction, and you may not feel like this market is bullish. I understand you. I get all that. But a chart's a chart. We're above the moving averages. We're just about to get a 20-50 moving average cross. We're just about to get that, which is another check mark of, hey, this thing is now more bullish and bearish. You have to trade the market in front of you. Don't trade your opinion, trade the market in front of you. This week, I think this week was a tough call here. As I said, we've got this range of resistance, and I think we push up a little higher into it, but I think we are out of gas at the moment. So I'm going to look for a 0 to +1 this week, just a pause. And then if this market can hold these recent gains, then I think the next leg is to the upside. So let's take a look at some sectors, Darren.
Yeah, and the sectors are telling a really interesting story. I mean, everything, last week we had a lot of things, clumped together at that 0 and +1. And you're going to see a pretty good shift to the right just based on the moves. Top ones that we're looking at, energy up 10.2%. And that's a sector. You've got to remember, that's a sector. So there's, in an ETF like that, you have a muting factor. So there's a lot of stuff that went up a lot more than 10.2% in the energy sector. And it kind of needed. It was looking a little rough in the energy. It had been doing really well for about a year for us. And, the past couple months, it just wasn't looking good. It's starting to regain some of that. Utilities, another one surprised me, up 6.5%. It's a huge move for utilities. And that this market cycle that we've going through, utilities have really surprised me because just the velocity and magnitude of the moves that something like utilities is making, I've never seen that much in what is supposed to be a very sedate sector. This cycle that we're going through right now, massive moves in utility. Let's take a look at individual sectors right here. So utilities here, I'm at a +1, and you can make me the case, well, this is supposed to be +2. Again, it's utilities. I think that we go up to about that, that 75.50 level. I think we bleed up into there. Then I think you've got a lot of resistance right there. There's a lot of people that have been waiting to break even on a lot of their positions that they held from June to now. So they've held those for 2 months, just praying to get back to break even. And that's where I think utilities goes. And then you've got that band going up there to 76, the 77 area right up there. It's going to be very tough to get up there. I'm not saying it's not going to happen, but it's going to take a while to get there. So that's why I'm not massively bullish on utilities. They've just come so far so fast. And I think that they're going to have to digest this gain and float up a little bit. Communication services. And you can see it really didn't participate. It really did not participate. I mean, it's up, 0.68%. Everything else is up 3, 4, 10%, and your communication services, was up 0.68. So I got this at a 0. It's just got a lot of resistance right here. It poked above it a couple of weeks ago, but then immediately came back down. This is the least bullish of everything. So I'm at a 0 on comm services. Real estate. This one's looking a little bit better to me. I mean, this is kind of the same situation we're in with utilities, where it's come very, very far, very fast. Last week, I think I was at a +1 on real estate. I'm at a +1 on real estate right now. We're just at that resistance area. We're probably going to break through it, but it's going to take a little bit of time. And then you've got resistance from March that is right above that. So it's going to have to claw through a lot. So I think we float up. I just don't think we see the velocity of the move that we saw this last week. Industrials. This one's, again, it's the same thing. I'm at a +1 where it's come so far, so fast, and it's got some resistance sitting right above it, about that 97 area looks at the next one. Then you've got, something at about 90, 98. I mean, it's just these stepstones of resistance. So I think there is room for it to be bullish in industrials. I mean, clearly we're no longer in a downtrend, but I think it's going to take some time to digest this move, and I think we float up for a lot of these things. Healthcare is one that it looked good before, and it looks even better right now. I'm at a +2 on healthcare. I say, well, Darren, I mean, why would you get a +2 on industrials? Because healthcare was looking better before, and it's digested the move a lot better than a lot of these knee-jerk sectors. What looks to me to be a knee-jerk reaction in some of these sectors to get them up, it digested the move a lot more. I think there's more of a fundamental base in healthcare that people want to be bullish, that it's reflected in the charts. People are in healthcare for the long term, and you're not going to see a whole lot of selling. So that's why I'm at a +2 on healthcare right there. Financials look better than what they did. I'm at a +1 there. Financials did have a gain. It didn't have as much of a gain as everything else. It was a little bit anemic. It really didn't have any. It really didn't break out till Thursday. Friday was looking pretty good, but it's still got a long way to go up there. You could make me the case for a +2, and I would believe it, but there's just those stair steps of resistance that are out there, and healthcare not healthcare. The financials just didn't look like they had a whole lot of faith in. So that I'm at a +1 on financials. Consumer looking a lot better. Again, consumer was looking good a couple of weeks ago. I'm at a +2 right there. Check out that gap up almost on Friday, above resistance. We didn't close quite at the highs, but we closed pretty close. So this is another one. It had been looking good beforehand, and I think this is one where consumer has bottomed for the near term. I think people said, okay, all the bad news is priced in, and I think we're looking up in the consumer space. So I'm at a +2 right here for that one. Tech is another one that surprised me. I'm actually at a +2 on tech. It's got a lot of ways to, it doesn't have as many of those stair steps of resistance. It broke through on Thursday really nicely. Friday was another good candle right there. And I really don't see a whole lot of resistance until about 147, 150 right there. So I think, tech in the near term, you could see it, make some moves up to that level. It would not surprise me at all. Materials, not as much of a good move. I mean, you had 3 good days, Wednesday, Thursday, Friday, but we were unable to get above that 50. Since we were unable to get above that 50-period moving average, I mean, that would have been a Herculean effort for the material sector to get above that because it's been so beat down. I would have been impressed. But, let me give it another week. I got it at a 0 right now because it's right at that cusp, that inflection point right there. Let's see if we base, move down, or move up. If we get above that 50 next week, I'm happy to go bullish on materials. If we base, like we said, even if we base, I'm happy to go bullish on materials. Just show me what you want to do, and then I'll decide which side of the aisle I want to be on. And energy up 10%, 10% for the entire sector. It's right at that 50-period moving average. This is another one. Just show me what you want to do. You got a massive move. Are you going to consolidate, or are you going to pull back? If you're going to consolidate up here in a base, I'm happy to see that. Happy to get bullish energy again. You're welcome back into the clubhouse. If you pull back, let me see where you pull back to. So that's where we are on all the sectors. So to link these things, you can see that we've spread out some more. We aren't concentrated on that 0 and +1 level. We've actually got some room in the field for the horses to run. At 0, energy materials, comm services are right at that 0. Energy materials, they're in the show me phase right now. I want to see what they're going to do. Comm services really looks like it wants to break down. So not all zeros are created equal. +1, industrials, financials, real estate, and utilities. Those are all looking good, slightly bullish. Let's see where they float up to, where they find the next resistance. Tech, consumer, and healthcare all looking really good. If you want to get bullish, if you want to get really bullish, those are the 3 sectors I'd be the most aggressive in. I'd be playing stuff a little more conservatively in anything that's a +1, and we'll wait and see where the zeros turn out. So let's take a look at some possible trades here. Last week we had a trade in utilities. That was NRG. We were bearish. And you can see, as much as utilities, second best performing sector, went up. If it triggered for you, you're probably sitting in a loss. That was up 5.9%. If it didn't trigger, then you're probably just in cash right now. This time we're looking at it in real estate. We're looking at Americold Realty, COLD. And this is one that's been performing a lot better. We're kind of at that resistance at 33, though. That resistance is all the way back from January. Right there, if we can break above that, I think we've got some clear sailing. So if you want to wait for that to trigger point, I think your trigger's at 33.25, which is 50 cents away. Once that happens, I think that's the time to get into a position. Be going out to long September's 30s and short the August monthly 35s. I think is the best way to do it. And so you've got basically 2 weeks, I think, to see how that trade unfolds. Last week in comm services, we were short AT&T, and this is one that, again, I was really surprised it went up. AT&T was up 2%. That's fine. If it triggered for you, that's why you size yourself for max loss. If it didn't, that's fine. What we're looking at now is WBD, Warner Brothers Discovery, and some possible trades we're looking at right here. I mean, you can see it's been in a low base, and it's come up. It's barely at that 50. There's a lot of resistance right there. And with the way the market, the general market was trading on Friday, you see that red candle for Warner Brothers on Friday. There's a lot of weak hands in Warner Brothers. So I think the best way to play this is going to be the August monthlies 14-16 bear call spread. That's going to be delta dependent. You're selling. You're probably going to get a buck risk, buck reward, and that's fine. It's data positive. But I think that's where you want to be. Give it the next 3 weeks. And healthcare. Last week we had long UNH, United Health, and that one performed for us. That was up 4%. So if you're in that, I think you got a couple more weeks on that one. And it's probably going to run. Again, healthcare is looking like a pretty good sector. Right now we're looking at CNC with a Centene. You can call this a high base, and this has been doing pretty good for a while. If you want to take a look at a longer term chart, you could say that we've had 6 months, almost in a sideways movement right there between the 78 and the 88 range right there, or the 80 to 88 right there. We just broke out a couple of weeks ago. This still looks good. When you have multi-month bases like that, you could have multi-month moves to the upside, and this is one that's been defying a lot of things. You can see that it looked good before a lot of other things looked good. So again, perfect thing for diagonal call spread, long those September 90s, short the monthly 95s, and reevaluate the trade on expiration Friday.
In industrials, last week we had GD, General Dynamics, And General Dynamics was supposed to go down. We were bearish, and it did not listen. It went up 4.5%. Look, the trade doesn't look terrible here. It could still have some time, but right here, right now, it's definitely not looking in our favor. This week in industrials, we have builders first source. And one of the things that we really want you to focus on is a lot of times when there's a market bottom, people go after the things that have done the worst. They go after stuff like DocuSign and Roku, and those stocks have been complete and utter garbage. Even though the market's bounced up, they haven't. You want to find the stuff that's already strong, that bottomed out. Look at this one. This one bottomed out well before the market bottomed out, and we crossed the 50-period moving average about 3 weeks ago. So the only thing on this one, we've got a bunch of resistance up here. So I'm going to be playing this assuming that this is going to stall out in this area short term. And so I'm really looking at this one here, looking to go out to September, do the 65 call and sell this month's 70 against it. So basically looking to pair it up in here in diagonal call spread. The risk graph is going to look like this. $70 is going to be our max gain point. Look, if it just blows through this and runs, okay, we didn't make as much as we could have, but selling that 70 will make it to where if this thing takes a while to get through this resistance, we're going to be making money during that time because we're in a trade that is theta positive. In the financials, last week we talked about Goldman Sachs. Goldman Sachs long, and boy, Goldman Sachs really listened to us on this week, up 5.9%. This week, Upstart Holdings. Upstart Holdings, this is what I'm talking about. Look at all the bounces we've seen in all these other stocks and sectors. This one doesn't want to bounce. So when you're out there looking for shorts, there aren't a lot of great shorts out there, I'll be honest with you. And all the shorts that I'm looking to take are really wimpy. I mean, take a look at this first one, this August 12th, 23.25. I mean, that is about the wimpiest trade you can put together. You're looking to play basically this area. If it goes below 23, you make your max gain. If it goes above 25, you make your max loss. That is really a wimpy trade. You could also take a look at doing this 2025. If you want to get a little bit more aggressive, I would suggest you put more time on that trade. And then you could actually go to the 20 area and say, okay, well, I want to play it all the way down to here. I think there's going to be a breakdown somewhere in the next 4 weeks. So you can really pick and choose your time frames on this one.
At consumer, last week we were bearish on Macy's. And as good as the consumer sector was, Macy's is in a downtrend for a reason that you can see right there. They were down 3.5% in a time when consumer was looking really, really good. So definitely some bearishness in Macy's. I'm going to hold on to this trade for a while. Right now we're looking at Starbucks and a nice bull pullback right there. And you can see we went down to the 20-period moving average right there. And we hit it, and then we had 3 really good up days right there. And what we're looking at, there is some resistance at that 86 level. So that's about $1.25 away. This is another thing. We're going to go out, to August 26th, go long those 82s. Give yourself about 4 weeks. We're going to short this next Friday's 85 against it. And you can see you were up there. It's, that's pretty much at the money, which you're going to get some really good premium, selling that 85. And if it blows past that, that 85, that's fine. You've had the trade for a week. You'll make a little bit of money. But if it closes, sideways, and it just expended a lot of energy, so it might take some time to get through that 85, 86 area, then yeah, feel free to hold on to that long call or sell something else against it for another week. So I'm really liking the way that Starbucks look right here. And technology, last week we were long take 2. It was up 1.8%, so it really didn't perform as much as we'd wanted it to, but it's still looking pretty good. There's some time left on this trade, so just take a look at that. This week we're looking at Bumble. We traded this one a few weeks ago, and that's the beauty of using a screener instead of a watch list. You can participate whenever this thing says it's time to participate. So I can't remember the exact date, but this is one that we were looking at before. It's based for a little bit right there, and touched the 20-period moving average, and then took off Wednesday, Thursday, Friday with everything else. That long upper shadow on Friday does give me a little bit of pause, so I'm going to want to make sure we get through the high of the body of the candle before I get into this. But I'm looking out September 35, long as that 35 call, and short this next Friday 40 against it. And I'm liking this because this is one that has been looking good for a while. You can see that it bottomed back in May, got above its 20 and 50 period moving average 2 days after it bottomed. And, this is good. So if it hangs up there, that 40 level between, where it's at right now and that $40, that's going to be our max area right here. Probably going to, if it goes down to the, about the 37 area, that's where you start taking losses. So just watch that. And, two different things you can do. Either you put a stop on it when you start taking losses like that, or you just size the whole position for max loss. That's probably what I would recommend doing. And then just enjoy the position as it develops.
In the materials sector last week, we had a call on Pan America Silver short, and the gold and silver trade that we've been milking for about the last 5 or 6 weeks finally turned around. A big jump in that group, and Pan America Silver up about 9%. So, look, these are volatile stocks. If you still have some time on that trade, it might come back. But this is why we position size for max loss. Say, hey, you know what? There's just one that didn't work. This week, we are also looking at some bearishness here on Huntsman Chemical. Now, Darren gave this sector a 0. I agree with that 0. And there was a big effort to get commodities back up. And so commodities had a great week. The problem is there the demand there to get back to where we were 6 months ago? And it just isn't looking like that. And so I wanted to go out and find something that is wildly underperformed. And this one here is Huntsman Chemical. If you take a look here, it hasn't really rallied. It hasn't bounced. We are still at our 20 period moving average, where everything else is like trading at or above the 50 period moving average. So on this one, I'm looking to do the 28-30 bear call spread in 2 weeks. And look, this again is a very wimpy trade. I think all of your bears, actually all of your bulls and bears should be wimpy trades here. Now, what I mean by wimpy, I'm just saying don't ask them to go too much. Don't think that we're in a raging bull or raging bear market where like, oh, this thing's going to move 20% in the next 2 weeks. It's not. So all we do in these situations, we just tighten our spreads down, and we do mostly spreads, no directional stuff, and just say, look, let's do a 28-30 bear call spread. You're going to get in $1. Your risk is going to be $1. Your reward is going to be $1, and you hold it for 2 weeks. It's a very, very wimpy trade, and you position size it for max loss. And it's going to be either a winner or a loser, and then you can move on to your next one. In energy last week, we had Occidental Petroleum, and you can see it had a nice week, up 7.7%. Now, the big move that we had in energy, remember, it just took us back up to the 50-period moving average. I think the energy sector has made a bottom, but I don't think we're going back to those grand days of everything going up like we saw back in May through June. I mean, this is just a monumental run and a monumental fall. So I'm looking at this saying, you know what? I want to play this one sideways. And then it's just a matter of, okay, where's the target? Now, you could be right at the money saying, okay, well, I want to do like an 85, 90, 95. You could be slightly bullish where you do a 90, 95, 100. Or you could be bearish where you do an 80, 85, 90. So basically what you're saying is I'm picking my target, and then everything's going to be based off that target when I put my butterfly on. The butterfly I'm looking to be slightly bearish. So the stock right now is at 89. I'm going to open up the 85 butterfly for 2 weeks. And my break evens, again, I haven't run it through a risk graph, but it's probably going to be somewhere around 82 and 88. So it's going to be a slightly bearish trade, but not too much, because I think that this sector in the stock is likely just going to hang out here for a little bit. If you have any trades that you want to share with the rest of the Maverick group, please go to the Maverick website, log in with your username and password, and jump into our forum, and let's get this discussion going on this week and the potential trades that you see in the markets. To wrap this up, we are firmly above the 50 SMA. That is our line in the sand at Maverick. Above that, we're bullish. Below that, we're bearish. We've been bearish pretty much all year long. And look, I love bear markets. I love trading bear markets. I like everything about them. And I'm a little sad that this one is potentially over. It's over for right now. You have to be at least neutral to bullish. You cannot be bearish at this point. And if you are bearish, it's because of your feelings. We don't trade our feelings. We trade facts. Right now, you can't argue with that facts. That doesn't mean that we have to be a wild bull. We just have to be not bearish at this point. On our schedule this week, we've got our midweek update as usual on Wednesday, so join us there if you can live. And Corey's going to be making a video about gamma scalping. He'll be sending that out to everybody this week. Everyone have a great weekend, and sorry if you've got kids in school. This is your last few weeks of summer, so you better enjoy it. Goodbye, everybody.
Good trading, everyone.